Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi everyone, Mason Clement here. Before we get into today's episode, I wanted to ask you one question. Are you sick of the wild swings in the stock market and ready to try something different? Did you know that investing in stocks actually put you at the very bottom of a company's capital structure, meaning that there's practically 0% chance that you're going to get any of your money back in the event that the company files bankruptcy? So basically, you're putting yourself in the riskiest position for a questionable return. Personally, I hate the unpredictability and just waking up and having half of my investment gone when I didn't do anything wrong. So what a lot of people don't know is that you can actually make higher returns on a consistent basis by investing in the opposite end of the capital structure, which is actually the safest place to be, which is on the debt side in a first lien position. And you can do that by investing in real estate, and specifically investing with my company in notes that are backed by the land that we purchase. So if you're ready to diversify your income stream, go ahead and go over to scalablerei.com and click on invest in the top right corner. There you're going to find a form that you can fill out to determine if you're eligible to invest with my company, Celion Capital, and we'll be reaching out to you to schedule an introductory call and speak more from there. So thanks a lot, and let's jump into the episode. Hi, Scalable Investors. Thanks for tuning in to another episode of Scalable Real Estate Investing. I'm your host, Mason Clement, and today we have with us Jorge Abreu, who is a real estate investor who's been in the space for over 15 years now. He's acquired over 6,800 multifamily units and wholesaled over 200 different single-family properties. So just a wealth of experience and knowledge here. Don't want to steal his thunder. So Jorge, let's jump into things. How you doing?
I'm doing good. How you doing?
I'm doing good. Before we started recording, I was glad to hear you're a fellow Dallas resident. So,
we're not too far from each other.
Yep. Yeah. And for any listeners that hear the background noise, George is doing some renovations. So just ignore any power drills and stuff you hear. But we're going to make it happen. It's all good. So what I like to do with every guest that I have on the show, just to start out, in case folks are not familiar with the guest, is just have you talk a little bit more about your background. And everyone's got their own real estate journey that brought them up to today. So why don't you get into that a little bit?
Absolutely. So my real estate investing journey started maybe about 16 years ago, and then full-time 15 years. So 15 years ago, I quit my W-2. I was working in the engineering department for UPS. Got an electrical engineering degree out of college. I knew I didn't want to be an engineer. I just wasn't sure what yet. So the path led me down real estate investing, started doing that on the side, and started really getting enough traction to where I felt like I was losing money at my W-2. So I quit and started doing it full time. That was back then. I was focused on single family, was doing a ton of wholesaling and fix and flips. I really enjoyed the fix and flips. So I wanted to scale that, and I ran into issues finding good contractors. So I decided to start my own construction company. That was about 12 years ago now. That solved the issue for me. It wasn't easy, but once I got it going, I mean, it really helped scale the single family side of things. And then as the market began to heat up, started getting a little more creative with our stuff, as adding extra square footage, and then finally scraping things down and just building from the ground up as well. So started doing some new development, started doing some smaller some fourplexes, eightplexes. And then finally got introduced to large multifamily syndications about 4.5 years ago, and fell in love with it right away. Like before that, I had no idea how these guys were buying apartments, like these large apartments. I thought you had to have millions and millions of dollars to come in with. I didn't realize that you can pull investors together and syndicate it and, you know, take them down that way. So started gaining the knowledge as far as the underwriting and what to look for, hired a coach, and put all my focus towards that. So that was 4.5 years ago. We've now acquired a little bit over 6,800 units. We've got another 1,000 plus under contract right now. This year has definitely been a test with where the market's going and with the debt market, you know, to continue to close these deals. We're working through it. We're starting to see some really good pricing. You know, the sellers are coming around. So yeah, I'm excited to keep growing the portfolio.
Okay. Yeah, it's really interesting. I just realized that you must have started in 2006, 2007, right before the last recession, right?
Yeah. Got in about a couple years, really good years. That was in South Florida. So I'm originally from Miami. And when the bubble popped, you couldn't touch anything in Miami. So for me to continue doing full-time real estate, my decision was to go ahead and move to Dallas. That's how I ended up here in Dallas. Turned out to be a great decision, but yeah, I've been through a down cycle, in other words.
Yeah, it's definitely a great experience, because at least you'll know what to expect this time around. It's probably not going to be as severe, but no one really knows what'll happen, right? So what was it like going through it? I mean, I guess Dallas wasn't hit as hard, but how was it like kind of setting up shop over here in Texas at that time?
Yeah, I mean, look, it was tough. Got a lot tougher closing on deals, and we just knew some of the pricing we were looking at and some of the deals we were sourcing that we had to find a way to close on them. We knew that the basis was low enough to, when that market started going back up, we were going to make some really good profits. So found some private lenders, found ways to get it done. I think it's going to be very similar in that case. So by no means do I think this correction is going to be anywhere near what we had back then. The fundamentals are completely different. But I do think there's going to be a great buying opportunity that we're possibly already in. And that window is going to close before you expect it. Like I know a lot of people look back, especially those that were investing back then, they look back at 2009, 2010, those years, and they're just like, wow, I wish I would have bought everything. So I said the same thing, right? I was still buying, but not nearly as much as I wish I could have. So that's kind of what I've been gearing up for now.
Okay. Yeah, I guess it's just a part of waiting for the sellers to come around too. Because what I'm experiencing in my business still is people expecting to get, peak of market prices, but my buyers aren't paying those anymore. They're bidding me well below my purchase price. So I got to renegotiate all this stuff and figure out things,
For sure. And I mean, we're sending in what I would have considered a lowball offer 6 months ago, 8 months ago, and I probably wouldn't have even sent it. So we're sending a lot of those now, and it's going to be a lot of follow-up and kind of just staying in front of them until those sellers realize, okay, well, my bridge loan is coming due. The market, it's not getting any better, at least as far as the debt. And I think they'll come around.
Do you feel like those debt maturities is what's going to accelerate buying opportunities, or is it something else?
I think that's definitely one of the main ones, for sure. And then cash flow, right, as well. If they run into cash flow issues because the higher rates with the floating rates could be another reason.
Okay. Yeah, I guess it'd be a lot of these loans, are they fixed for like the first 5 years and then they're going to adjust, go up with the market? Is that right? with the rates?
No, so I mean, not everybody, but a good majority of multifamily syndicators were purchasing properties for the last 2.5 years under bridge loans with adjustable rates. So a bridge loan is usually a 2-year term, started getting a little more extended to maybe a 3-year term and then some extensions. But either way, those rates are usually adjustable. So that's where it starts getting tricky.
Okay. Yeah. So that makes sense. It's not fixed for any portion of time. It's just automatically adjustable. And is it resetting every 90 days, or what's that reset period?
It depends on the loan agreement. Like some lenders do 90 days.
Okay. Got it. So going from smaller multifamily properties to syndications, how did you scale the business from that? I guess, like, was it what kind of bottlenecks did you encounter, and how did you go from that to those smaller duplex and fourplex to now? I mean, besides teaming up with a coach and learning from him or her.
No, definitely had to build up the team and do it organically and not get bogged down with the overhead and run into issues with overhead and not having enough deals and income coming in. I know that's an issue that a lot of multifamily syndicators run into, is to gain that traction. It takes a bit to start being able to close on deals on a consistent basis. So what I've done is just kind of wait till I see that bottleneck start to build up a little bit or anticipate it, and then find somebody to come in and help us in that spot. But that first bottleneck was in acquisitions and just being able to analyze as many deals as we really need to find the ones that fit our return metrics. So we brought somebody in to help there. Then as we started getting more and more investors and we started doing more and more deals, we needed somebody to help us with the raising of the equity side and handling our investors and working with them. And then we ran into, next one was, okay, well, now we've got 4,000 units, 5,000 units, it's growing. We need somebody to come in and help with the asset management part of it, because we can only do so much. So that's the approach I've taken. It's worked so far, and yeah.
All right, that makes sense. Yeah, just kind of hiring out those needs as they become very clear.
Yeah.
Teaming up with them. All right. And what's your usual strategy? Like, what's the typical holding period? And is that a refi to return capital to investors and then like an indefinite holding period, or are you actually selling the asset? How's the process work?
We don't have a set process. We've got structures all across the board. We've got some where we've got it in at a really low basis. It's a heavy lift. We know we can add a ton of value to it. So that one would be more of a return a lot of the original equity back to our investors, and then hold those on a little bit longer, maybe certain hurdles where since the GP split with the LP split will be a little more favorable on the GP side, depending on how fast the capital is returning to our LP investors. And then we've got some that are pretty standard, like a 70-30 split, and 70% of it goes to the LP investors, 30% goes to the GP investors. We project all our returns off 5 years, and that's how we look at it in the beginning, and what we present to our investors is a 5-year term. A lot of the stuff that we've been doing has turned a lot quicker. We've been able to hit our 5-year projections in 1 year. Now where the market's going, that might be changing a little, but we're always looking to try to get our investors at least 2x their money within those 5 years. And if it happens sooner, great.
Okay. And is it primarily value add strategy, or are you doing any ground up development with your construction company?
So we are doing some ground up stuff with the construction company. I have yet to syndicate one of those though. It's mainly been with partners funding it, the equity needed. I do see in the future probably syndicating some of those, but a lot of everything we've syndicated so far has been value add, like you said. Even some of we've got some Class A properties, newer builds, but still a decent amount of value to be added to those, where we've noticed the developers are a lot more focused on just getting it occupied, not necessarily being efficient operators. So we've had some really good success on those deals as well.
Okay, so what are some of the ways that you added value to these properties?
Yeah, so there's one that we closed late last year. It was just getting through the lease up period. I just got in, it was right under 90% or right above 90%. So we got in and right off the bat, we started raising those rents. We noticed that the market, it was about 150 to 200 off the market rent. So we did that. We added some other income that they weren't capitalizing on, internet, cable and internet, offering a smart package for the units as well. And then cutting out some of the expenses. I can't remember exactly, but we've now decided to actually list that property for sale. So the goal is to sell it, right after the 1 year mark. And we just looked at the projected numbers. I mean, it's projected to be a 3x for our investors in 1 year.
Okay, that's definitely great. It sounds like a good deal. So it's not necessarily always going to be a Class B or C property, right?
Correct.
It's like you said, it's Class A. So it's like, what year was that built? The Class A?
2020.
Okay, interesting.
Yep.
So when you're sourcing deals, is it primarily just looking at leads from brokers, or are you also doing some direct to owner marketing for off-market deals, or how does that work?
So we started doing a lot of direct to seller. That's how we did our first 2 deals. And then kind of started getting bombarded with deals from brokers, and we're able to build some really good relationships with some brokers where we would get first shot at the deals. But now we've almost kind of gone back to looking for those straight to seller deals, just because we really need to feel comfortable with the basis that we're getting these deals at. And you're always going to get the best deal when you're dealing directly with the seller.
Yeah, I agree. That makes a lot of sense. And I guess even if you're looking at it first before anyone else, before a bidding war starts, I mean, that the broker is going to want a little higher price to have a higher commission, right?
All right, I had trouble unmuting myself there. That is correct. That is correct. The broker is also going to set an expectation. They're going to do their job, right? Their job is to get that seller the highest price possible. So bypassing that if we can. And I love my broker relationships, and brokers do an amazing job. But yeah, if I can somehow get to that seller first, I can probably negotiate a better deal.
Right. That makes sense. I mean, they're adding value because they're obviously serving as the super connector and doing all that footwork for you. But it's kind of a price to pay with a kind of implied price there within the purchase price. So, what is the usual motivation? Like, so for those first two deals that you did, for someone to sell? Because say, if like from an outside point of view, it's like, why would anyone sell this great cash flowing asset and like the kind of gold standard for real estate type of property?
Yeah, I mean, I think a lot of different reasons. Usually we've seen different projects that they want to tackle, and they want to either, we've seen a lot where they want to move up to the next class level. Maybe, maybe we're looking at buying a C class from them, and they're looking at only doing A class properties moving forward. So they just want to get out of that asset class. Or on the developer side, developers usually always have the next project they want to move on to. So they want to take that cash out and use it on the next project, or use some of it on the next project. And then there's the ones that you just never know if somebody's running into an issue with payments and their loan or cash flow. Maybe they're bleeding out every month. So that can also make them motivated, obviously.
Right, that makes sense. And I think from my experience, it seems like the perfect seller would be also like this mom and pop, maybe less sophisticated operator, but just given the kind of the way that multifamily is structured, it's probably 80% or more owned by institutional investors, or at least other syndicators, right? So what's the typical seller profile that you've been encountering?
Sorry, man. Dealing with a lot over here. Typically you're right. So I wouldn't say institutional, right? But a mixture of more sophisticated institutional syndicators. You still do have your mom and pops, especially in your smaller cities, which ideally, yes, I would love a mom and pop. And if they're giving me their financials on paper, like, that's great. That gets me excited. But depends on, obviously, if we're getting a class A deal, or maybe a B plus type deal, that's most likely not going to be the case as far as a mom and pop. So in that case, we'll be a little more sophisticated, but hopefully there's still enough value there to add.
Okay. Yeah, I mean, that's the main thing, is to make sure there's still enough meat on the bone on that deal, right? So actually, it goes back to the next question. How many deals do you really need to go through to really find the one that meets your return metrics, your requirements, and like how long does that take to go through all those?
Man, it's a lot of deals. I would say in the beginning it was probably like 100 deals we would have to look at to find one. We've gotten a little bit better with our relationships, and just being able to quickly look over a deal and know if it's going to be anywhere near our return metrics. So now maybe 20 to 30 deals. But now that the market's changed, that number's probably even gone up. So.
Okay, that makes sense. And just going through your website, it looks like most of your properties are in Texas. But do you have any other areas that y'all are invested in?
Yeah, I mean, we've got about 1,000+ units in Oklahoma. We've got we had in Georgia, but we ended up selling that deal in Augusta, Georgia, but we're still looking there. Got a deal in South Carolina. We've got 300 contract in Florida. We've got about 500 units in South Dakota, and definitely open to other locations as well.
Okay. Yeah, this is just mainly the way that the local market is. Huh? Are you usually looking like just across the entire country, or do you still kind of have your specific markets that you've picked out?
I mean, we're open to looking at new markets, but we definitely stick to the Texas, Southeast, and then the Midwest.
Okay, that's cool. And also back to the mom and pop operators. My theory or thesis is that the smaller the number of units, the more likely you are to find mom and pop operators. So, do you feel like that's true? And like, if so, what's kind of the cutoff point for total units to where you start seeing more and more sophisticated operators?
I agree with you 100%. Yeah, the smaller units, more mom and pops. We don't like to do anything under 100 units. It's a lot easier to manage and operate when it's 100 plus units. So when you're dealing with 100 plus units, there's not a ton of mom and pops, but I would say maybe once you get above 200 units, it really starts getting pretty slim. And then I don't think I've seen anybody above 300 unit be a mom and pop.
Okay, got it. That makes sense. Yeah, I remember I didn't complete the entire program, but I bought Brad Sumrock's like home study course on evaluating multifamily properties, and he had talked about needing to focus at least on like 30 units just to be economical to hire a property manager. But really, I guess I forget what exactly it was. It was like 50 at least. You're saying at least 100. So I guess
Yeah, I mean, I think maybe 80 you can have a on-site manager, but it's slim. I mean, 100 is ideal. You can have one manager and one maintenance.
okay. And is the maintenance person like a live-in super that lives in one of the units usually?
It could be. It definitely could be.
Okay. And do y'all ever give a piece of the equity to the property manager to align incentives?
We've done that once or twice, maybe twice. There's pros and cons. If you do that, you got to make sure that you can fire them if you need to, if they're not performing. There's a clear picture of what that looks like and how you get them out of there.
Okay. Yeah, I guess you just have some contract in there that I guess yeah, I know what you mean though. It could be a little stickier, trickier to get them out. And like, I guess if you fire them, do they retain their equity? Do you know what the usual procedure is?
I mean, look, an operating agreement is, you can put anything in there, it's all negotiable. Usually they would, if you don't pay a lot of attention to the operating agreement, most likely they're going to retain it. And, there wouldn't be anything where you can't fire them. It's just going to be a little awkward. And to me, I'd rather just have it laid out. Hey, look, if you don't hit this for this many months or whatever, then we all agree that we're going to bring somebody else in. And I wouldn't necessarily, depends as far as taking their equity away or not. Depends if they brought anything else to the table or if it was literally they were just going to manage the property. So it's all negotiable.
Okay. And also just thinking back to the smaller units. So say it was like 10 or 15. I wonder if there, because there's like single family property managers, and then there's like, larger sophisticated multifamily property managers. But I wonder if you could get like a single family property manager to do one of those 15 unit ones. Like, where does it break off, where there's a clear differentiator?
No, you definitely can, and I think that's what some others do. The problem with it is your expenses. Your expenses become so high. You're paying them a certain percentage, and then depending on how you're managing that, usually on those smaller ones, I guess it'd be included in the percentage. And your percentage is going to be more like 10% or 8%, versus the typical, 2.5 to 3 that we pay on our larger ones. I don't know. That's I owned those fourplexes and eightplexes a while ago, and I didn't enjoy the management part of it. I had to be pretty involved because I couldn't make the numbers work by hiring one of those companies. And then I had a 37, which we were able to bring in a manager, but it was tough to get those expenses where they needed to be to really get that property cash flowing where we wanted it to. And we were having to be more involved in the day-to-day because we didn't have that full-time manager on site all the time and that maintenance on site all the time. So it's doable, but I think it's a little harder.
Okay. And I guess just thinking practically here, you might, I guess on any given day, you have, say, 5 toilets that need repair and just a number of different units at any given time. And so you couldn't just hire one handyman that's available on a call's notice. Is that correct?
Good, but I mean, financially, if you're going to cost, a third party every time you've got something that comes up, it's going to add up more. Depends how many units we're talking about, but usually that would add up more than having somebody on payroll.
Okay. Got it. Yeah, and actually thinking back about my other question about getting a single family manager, obviously it wouldn't be ideal to take a larger percent. So you'd want those guys taking 2.5 to 3%, but they're not going to agree to that ever on a smaller property. They probably have a threshold, right? Oh, we don't manage anything unless it's like you said, like 80 units and up or something like that, right?
Yeah, that or they'll have a minimum instead of a percentage.
Oh, okay.
Have a minimum amount.
Got it. Yeah, you have to pay X dollars per month or percent, like the greater of or whatever they say. Yeah.
Correct.
Okay. Cool. So if someone wanted to invest in one of your offerings, do they need to be an accredited investor? Like, do you only do 506C offerings, or do you do 506B as well?
Most of the ones we do are 506Cs where you have to be an accredited investor, but every once in a while we do usually it'll be one of our smaller deals, maybe like 100 unit, 100 and something unit. We'll go ahead and do a 506B, as we do have investors that are not accredited and would like to continue to invest with us. So yeah, every once in a while we'll do some Bs.
Okay, perfect. And is there like a website or something someone could go to learn more about your company and just see if they could qualify for investing with you?
For sure. On our website, elevatecig.com, stands for Commercial Investment Group. So elevatecig.com. We're constantly updating the site with free content. If we've got any investment offerings, we do a lot of events. We've got 3 events coming up where 2 of them we're going to be walking properties that we've already repositioned. We're going to have investors come or potential investors come and take a look. And then the other one is just a meetup, which you're welcome to come. It's here in Dallas. And yeah, we were doing a lot of that before COVID and having anywhere from 150 to 200 people show up. So we're excited to get that going again.
Okay, perfect. Is there actually like a meetup.com page, or do they just need to email you or something?
Yeah, they can email me for sure. My first name, Jorge or George, Jorge at elevatecig.com. Actually, usually say if you email me, you tell me you heard me on this podcast, I'll go ahead and send you free content. So I've got a bunch of checklists and other stuff that I can send out. Also on our website. So if you go to our website and then there's an events tab on the top, you'll see all the events that we're hosting or that I'm going to be at.
Okay, perfect. Well, this was definitely very interesting. I think that I learned a lot, and hopefully our listeners gained a lot as well. Is there anything else that you wanted to mention before we hop off?
No, I mean, I think I've enjoyed it, and I hope I was able to add some value to your listeners.
Sure, perfect. All right, great. Thanks a lot.
Thank you.
All right, that's another episode of Scalable Real Estate Investing. Thank you for tuning in. Please be sure to leave a review and subscribe on whatever channel you're using to listen or watch these episodes. And also be sure to go to scalablerealestateinvesting.com, scroll to the bottom, and fill out the form to sign up for our email. And you could also reach me directly at mason@scalablerealestateinvesting.com. That's MASON at scalablerealestateinvesting.com. If you'd like to get in touch with me to either partner on deals or even be considered to do your own episode on this podcast. Thanks again, and have a great day.